Earnings are nice. Guidance is probably more important. What are you expecting from both?
So I think we need to move beyond this this beat versus miss paradigm, Brian, because clearly the companies have understood this and tend to lowball estimates. But as you mentioned, we just cut all our estimates for digital ad spending through the second half of the year and into 2023, because clearly some of the impacts of a recessionary climate, even if Janet Yellen, as mentioned before, doesn't see it as a recession, this climate is clearly impacting companies. And I think for a lot of the big tech companies, you'll see that in their, if they give guidance at all, you'll see that reflected in the language around their outlooks.
Yeah. Well, if you say a downturn in the digital ad market, I mean, my sort of radar goes off. That's not good for Google. That's not good for Facebook.
So that's going to be different for both the companies. First of all, in the case of Facebook, they have an incredibly easy comp for the third quarter coming up, where last year they had a sequential decline in sales. But we forecast that they won't grow. They'll have flat sales in 2023 because they're in a business model transition to more hardware and higher content costs. In the case of Google, they're insulated a little bit with something called search, because you're seeing a shift, and this is one of the big themes in the market, a shift away from discretionary product spend towards services. You just mentioned travel, when the airports are crammed. Well, you do the same type of searches for travel that you would to find product. So Google has sort of a hedge depending on the spend that consumers have, whereas Facebook, which is more linked to e-commerce, doesn't. And we just actually initiated on Etsy this morning with a sell rating. We think they are in the crosshairs, if you will, of that discretionary spending by consumers that is clearly drying up.
A sell on Etsy. Any others?
Mm-hmm. Well, we do have sells on quite a few companies. We downgraded Twitter to a sell because I think the numbers there were very poor. And, you know, there really is no certainty that Musk is going to be called to account and forced to buy the company. And again, you compare them with Snap, which was absolutely slammed last Friday and sort of reversed this bear market rally in a lot of tech for sales that were up 5% sequentially. And Twitter's sales were actually down 3% sequentially. So you see they're coming from different positions. And I think Twitter's slide into a $270 million net loss it doesn't bode well for a company that spent $2 billion buying back its own stock in the first quarter of the year and now has less than $1 billion net cash on its balance sheet.
Yeah, and we're showing Snap. I mean, that stock got crushed. What was it, 30+%? I believe it was on Friday, yeah. Richard. And wiping out years of any investor gains in that name. You may not have to name the names here with this question, Richard, but are we going to see any kind of a big public company in tech go to zero effectively? I mean, it seems like these companies, they either got to turn around or they're going to go to zero at some point.
Yeah, so some of these companies are clearly going to have the money, the rug pulled out from under them. I think, as I've mentioned to you many times, Brian, big tech is going to outperform because Google has $119 billion of cash on its balance sheet. Apple has around $70 billion. Facebook has around $50 billion. These companies are better managed, and they understand how to mitigate their variable costs and to manage risk. What you see with a lot of the smaller companies, and we've talked about this before, is they don't have the adult supervision in the room. This is something that Evan Spiegel's founder at Snap got with Jeremy Gorman coming in. This is something that we'll see if it changes at Pinterest, where you had the founder CEO step aside and you brought in a new CEO experience guy from Google. But this is a problem at Shopify, at Spotify, at Twitter, at many other companies, that these founder CEOs are still running the show as if they have unlimited capital to hand. And that's just not going to cut it anymore. You really need seasoned management that understands how to cut variable costs into a downturn.
Why wouldn't they act like that? People threw hundreds of millions or billions of dollars at them. They're walking around their T-shirt using buzzwords. Now they own $50 million mansions in Tahoe. They don't care about investors. They've made their money. They're billionaires now.
One other thing you're going to see a lot of, and we're already seeing the first bit of it, is you're going to see a muddy the waters M&A trend. So you saw Unity Iron Source. This is a company that had Unity had gone from $224 to $30. They did a giant $4.4 billion all-stock merger with IronSource, another troubled company that was a SPAC, went from 10 to 2. And now what they're saying is, oh, we'll have synergies by the fourth quarter on a run rate basis of 2024, which means we can make a date to come back in February 2025 and see if they've actually hit those numbers. They're buying time. And so you'll see a lot of companies huddle together with M&A to try to hide what's going on in their real business. That's actually something we think Etsy's done with the last 3 acquisitions. They want to hide the slowdown in its core business post-pandemic. So they've made a bunch of deals. And that simply won't work if you don't have management to integrate those businesses.